Hi everyone, this is Nikhil Mishra from Setu Capital. Today I will be discussing with you all a very niche category related company which deals into the agro related exports. The name of the company is Gujarat Agro Exports Limited. So this particular company is at a very crucial stage, and we'll have a look why it is so. So let me share the presentation with you all. So this is a this is this is a very hidden company, I would say. Very few people have idea about this company. Very few sell side brokerage houses do track this company. The reason being is that this company doesn't even conduct a quarterly conference call, nor does it give any sort of annual quarterly presentation. That's why there is not much focus on this company. Even if you look in the valuations in the past, the company has been growing at slower rate, but but was not given any due credit which it deserved because of the improving efficiency. So this company is India's largest maize processor. It is transforming from a low to high growth trajectory, and it is the transition is directly from low growth to high growth. It's not going to be a from low to medium then to high growth. So first and foremost, nothing which we talk about should be construed as an investment advice. I might be biased, my clients might be biased. You guys should be doing your own research before taking any investment decisions. So the overview of the company is that it has the largest export producing capability in India related to maize and its maize derivative products. So it is mainly focused in maize processing and edible oil products. It has 20% market share with around 1,250 tons per day maize grinding capacity. In order to enhance production, it is setting up around 400 to 500 crore of production, capex during the upcoming years with a value added, mainly focused into the value added products of starch derivatives, polyols, etc. So value-added products do generate better margins. That's why most companies do focus on them. Try to focus on them as they evolve and progress in their manufacturing capabilities and the distribution channel and the product pool. So this company deals in corn processing, solvent extraction, cattle feed, flour mills, renewable energy, cotton yarn. Though renewable energy is just for the in-house consumption. In most companies which are listed, and they don't, if you will find that they don't have anything to do with renewable energy, that is mainly for their own in-house production. Because what happens is that these companies are not generally located in the towns. Okay, their manufacturing plants are at the far away places because they need to have large tracts of land which doesn't come cheap, and that's why they have to put in production into some outskirts of cities or in the village areas where there are large chunk of land should be available free from all sort of encumbrances. So they have to rely in-house, and the DG sets or diesel generators do come at a very steep cost. The cost of production of electricity through them is very high. So most companies sooner or later start focusing on producing in-house. The application of these industries, basically food related products, they go into different industries, mainly food, feed, cosmetics, industrial users, pharmaceuticals. So their product basket, so they have their own brand, Ambuja Gold. They package the products and they do export and also supply domestically, but mainly they focus on exports. So this is a very well diversified company which has all forms of strategically located plants. You can see that the plants are located in mainly into the areas where they are They do have a production advantage simultaneously and export advantages. You can see that the it has multiple plants in Gujarat. It also has processing plants in rice abundant states like West Bengal. They have a plant in Malda, and for others as well, for other products as well, they have multiple plants, all diversified across the country. So let's have a look at the internals. So the company generates a revenue of around 4,670 crores. It makes a profit of around 475 crores. Most of the revenues do come from maize processing, then after mostly from other agro processing, and then cotton yarn. Cotton yarn constitutes lower amount. They have 10 state-of-the-art manufacturing facilities. They do export in 75 plus countries. They have 5 lakh tons maize warehousing capacity, 1.5 lakh tons of soybean warehousing capacity. Now, financials. Let's have a look at the financials. So if we see that in 2017-2018, this company had made a revenue of around 3,300 crore rupees. In 21-22, it made a revenue of around 4,600 crore rupees. So by any means, this company has been growing at a CAGR. If we take the last 4 years, it has grown at a CAGR of nearly 9%, which is even lesser than the nominal GDP of our country. India's nominal GDP grows at a rate of 12, 13, 14%. Obviously, most of the companies basically who are focused in the Indian segment should grow at this. But the caveat is that the food related industry is not growing at a very fast rate. Generally, the world average is around 5 to 6%. This company has been growing moderately more. So uh, many of you might have a question that, okay, if this industry is itself growing at a very slow rate, then why is it so that why is it so that this makes a good investment, and why do you think that they will be able to grow at higher rates going forward? Now the question is quite right, but what we are missing is that this company has transformed itself into one of the lowest cost producers of products, and it has become export it has come to a stage at which it can compete with other producers of products and take away market share from them. If we take a classic example in tires, although the tire industries of highway tires, basically the ones which are put in cranes and JCB and all, they don't, or in agricultural products, they are not growing more than 5-6% annually. But there is a company called as Balkrishna Tires that has been growing in the range of 15 to 20% consistently over the years with margin improvements. They have thousands of SKUs, and they do maintain a price difference of around 5 to 10% from the competitors. By the competitors, I mean to say the larger American tire manufacturers. So the same case will happen over here as well. This company has become cost uh, competitive, and hopefully it will be able to take market share from other competitors. Although being a 5,000 crore top line company is just a grain of salt in the whole desert, grain of sand in the whole desert. So it doesn't make any sense. The food basket is quite large. Looking at the profitability, although the PAT has grown at around 9%, but the profitability the PAT has grown from 180 crore to 475 crore, which is equivalent to around 2.5 times, more than 2.5 times in a similar period of time. Why has it happened? Because the margins of the company has been increasing from 9.6% to 15.86%, and obviously the earnings per share has not been has also grown at in a similar fashion as have the profitability. The company has been consistently making capex in order to enhance its production capacity. Last year, it did a capex of around 277 crore rupees. So where have the sales come from? The sales have come mainly from the maize processing, 2,600 crore, other agro processing and cotton yarn. Now let's look at the key ratios. This is very important. This is very important. If we look at the, although we do have had a look at the net profit figure, but I just wanted to make a comparison over here that you can see that the net profit and cash flow from operations. So this is a important distinction. So these are cash profits and this is the accounting profit. So this particular company, if we take a 10-year average, you will find out that the cash from operating activities have grown at much higher, is larger than that of the net profit after tax. What does it mean? That the company is very efficient and it has been able to convert its profits uh, more than more than the net profits which it has generated. What does it mean? That it has been able to squeeze capital out of from working capital, means it has improved its working capital capability. Capex, we just had a look over here, 277 crore rupees. They have made a 277 crore rupees capex. Now, net fixed asset turnover. So net fixed asset turnover is an indication of how many times the company is able to generate revenues given this much amount of assets are on the ground. So this company has around 6 times on an average, 5 to 6 times NFAT, which is a good number, I would say, which is a very good number. And looking at the receivables, it's even less than 1 month, half month, 17, 18 days. This showcases what pull this company has on its own of its own products. You can understand that what generally, since most of the products are being exported, what does it mean? That the importers of these products have to have to generally um, pay more or less, means in line, that they have to pay advance or they have to take some money, give some money to the company and then import. Obviously, there must be some line of credit involved because there is export and import involved. Coming on to inventory turnover, the inventory turnover is 5 to 6 times. Basically, the company maintains an inventory for 70 to 60 days. What does this mean? This means that the company, despite being in agri sector, just has an inventory of around 2 to 2.5 months, which is very good. If you look into other companies, although in the similar industries, not exactly the same because this is a processor, but still companies like the rice or basmati rice producing countries, companies like the ones who are listed about, I'm talking about them, the KRBL, Chamanlal Sethia, etc. What you will find is that they do have an inventory of around 100, 200, 300 days. That happens. Although there is another factor over there that people do prefer rice which is older. There is some fragrance which comes out of those rice if they are old. That's another factor, but still, if you are maintaining inventory, it is taking away your working capital and it has it's basically tying up your capital, which is not good for us capitalistic point of view. Now, return on equity has been improving, although in the year March 2016, it was a bit down, but after that, it has been consistently improving. ROC is also in the similar line. ROE and ROC is more or less in the similar line. And now coming on to the borrowings, what you find out is that the borrowings is 268 crore rupees in FY22. Now, equity is much more larger, but one thing has to be understood over here, that this company has most of its borrowing is because it doesn't have long-term borrowing. It has short-term borrowings. They are current liabilities. They are used for working capital. They are used for working capital. This company is more or less debt free. We'll have a look about it in the future slides. Now, there are some financial observations which were very interesting, which I found. The first one, which I just now discussed, that the long-term liabilities are simply 2.62 crore. which is nothing. Basically, this company is a debt-free company. Now, the other thing is that this company earns a lot of foreign exchanges. As you can see, that it earns foreign exchanges. 1138 crore have come in, while 462 crore have gone in. Another interesting fact of the matter, which might be of interest for many people, is that if we look into the remuneration of the management of the chairman and managing director, it it shows that he had taken away home around 68 crore rupees in FY22. Now, most of it, although he has a salary of around salary and allowances of 84 lakh rupees, but most of it came from commissions. So, what happens is that the promoters of the company can take a percentage of commissions. Now, in his case, in this particular company's case, what I found is that the company is making around 460 crore rupees of profit. This person has the CEO, sorry, the chairman and MD has taken around 67 crore rupees out of those. Means what, he has taken approximately 15% of profits, which is a very high number. From my own personal experience, what I found is generally the promoters, although it does depend on the scale, but still they take around 2 to 3% of of commissions. But in his case, it's relatively high. Although it, he if only time will tell that how he has been taking away the company and what direction he has been taking. And although given the fact that this belongs to promoter, a largely promoter owned company, and they do have majority shares, so they do have enabling shareholder approvals. But still, this is, from my own personal experience, this is relatively high, in the higher side. Now, if we look at why I'm particularly saying is that the median remuneration of the company of the employee of a company is around 2 lakh rupees. Okay, but we don't have to get into this narrative of from 2 lakh rupees and 68 crore rupees. Those are completely different set of dynamics and capabilities which they bring to the table. Most of the employees on the lower segment are laborers or contracted laborers, so their remunerations are generally less. This company has around 2,600 employees, if I'm not wrong. I'm talking about the permanent employees. We'll have we did go through it in the first slide itself. Now, this was an interesting highlight. Let's move ahead. So, on coming on to what will happen now. Okay, this is what has happened in the past. The financial, the plant setup, and all the capex which they have done in the past. What are the remunerations which the management has taken, and etc. etc. Now, in the upcoming years, they have commercialized 1,000 ton per day corn wet milling plant in Uttarakhand. They will also be starting a construction of 1,000 ton per day corn wet milling plant in Malda, which should be operational by Q2 of FY24. They will be launching 2 new sorbitol plant. Now, this is a polyol. This is one of the derivatives, uh, value-added products. Sorry, this is one of the value-added products which they are getting into in Hubli and Uttarakhand. Operations will be commenced from Q2 FY23. Now, the most important thing which attracted me to this particular company and made forced me to uh, take a deep dive was the in the in the in the annual general meeting there was, and subsequent interviews with the media as well, the management guided for a 10,000 crore top line by FY25, which basically boils down to around 28% CAGR, compounded annual growth rate, means year on year. This company will be growing by 28%. They have a revenue of around 4,670 crore rupees in FY22, and from here they will be growing by to 10,000 crore, which is 28%. Now, in the last 4 years, this company has barely grown by 8 to 9%. And now they are targeting 28%. So the journey is going to be very interesting. So margins as per management may be difficult to predict, but given the pedigree of the management and what they have accomplished in a relatively difficult sector, which involves a lot of labor related issues, a lot of management management bandwidth is required in order to handle these situations, because you have lots of people on the ground, then you have to export, etc. So, and the management being quite reticent, they they won't make such target just in order to impress the broader markets. They are real deal. So that's why I was bound to take a deep dive and did my own research on this company and thought of sharing with you all guys. Now, coming on to the valuations, the company being a slow grower in the past. See, the what excites the most is to the markets is the growth rate, and that to efficient growth rate. If there is growth rate, then market gives you better valuation. But if you are growing it efficiently, it makes you to sustain at high valuations. Now, in the past, if you see the companies, now you might get a bit astonished by looking at 0.1 times price to sale in March 13. But historically, if I talk about March 13 and 12-13 was a very, very good period for any Tom, Dick and Harry to get into the markets. They would have made a killing, I would say, north of 30% returns, because that was more or less the bottom. After that, there was a cycle till 2017. If you picked any small cap during those periods by using darts and obviously made a basket of it, the small caps and mid caps grew by more than 30-35%. Their 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 fundamentals might not have grown by the same value, but their stock prices did. That's why there was an elongated correction in 2017, 18, 19 for small caps. Although the Nifty did keep on increasing its rate of growth, but small caps and mid caps were brutally down during the consolidation phase of 18 and 19. So the company was historically trading at less price to sales. Now, see, there is no as such hard metric for using particular valuation. That's why I have used all three of them. If you want to talk about the reliability, I would say price to book is a better measure of valuations compared to price to earnings. But price to earnings also does give you a lot of context about what you are paying for every rupee you earn. So this company presently trades at 1.4 times, while it was trading at relatively lower valuations before. But the caveat over here is that this company was not even growing at higher rates. Now everybody has slowly the market and the intelligent participants of the market have taken a knack of the situation, and that's why there has been a derating in the company. It trades at price to earning ratio of 15 times and tries to book of 3.32 times. Now, if this company is able to generate 28% CAGR with more or less stable margin, this particular stock will even get more re-rated going ahead, because there is return on capital is there, return on equity is there. Both are north of 20%. The receivables, there is no problem of receivables. There is 18-20 days of receivables. It's a highly cash generative company. In a company, if this company is able to grow at a rate of 28-30%, let's say 20-25% even, still, what does it mean? It simply means that there is a demand for its products. If there is a demand for its products and mostly into exports, which means that it is more cost competitive. And if it is cost competitive in the global arena, then it has a very small, minute market share right now, and it can easily take away market share from other players, because the advantages come from the raw material sourcing and then processing it and then exporting it. So not every company can get into this business. They need to have strategy located ports. They need to have readily available um, labor. They need to have a competent management who understands the situation, is able to willing to put in capex ahead of what is required, so that the benefits can come accrue afterwards. And the cherry on the the cherry on the cake or the icing on the cake would be the value added segments which this company is getting into. I hope you guys have have understood the basic changes which are going on in this company. So I would say that this brings me to the end of this presentation. I would thank all of you for watching patiently this video, and I would also request you to do subscribe and like my channel if you wish to view such engaging content going ahead. So thank you very much.